Good afternoon. This is Sean Golding with Golding & Golding, here to discuss a very common issue we see often, which is when taxpayers have unfiled tax returns that includes foreign income. They also may have some overseas assets, investments, accounts. What do they have to do? Is all hope lost? It's not. How to get into tax compliance, FBAR reporting, all that good stuff. So before we begin this, it is important to note that you have to avoid the fear-mongering that you will undoubtedly find. For some odd reason, people really like to take advantage of people who find themselves in these types of positions. Oftentimes, it's not willful, it's not criminal, and even if it is willful, there are IRS programs to get you into compliance. So all hope is not lost. You're most likely not going to prison or jail or anything like that. So from a beginning point, or from a jump-off point, tax return filing is required by U.S. persons. U.S. persons generally includes U.S. citizens, lawful permanent residents who have a green card. Even if you don't have a green card, for example, if you're a U.S. person on a green card and your green card expires, well, unless you voluntarily abandon the green card, you may still be subject to tax filing. Visa holders and other people who meet the substantial presence test. SPT is the acronym for substantial presence test. U.S. person doesn't only include individuals, but that's what we're focusing on. You know, if you're a U.S., you may have a U.S. trust or U.S. corporation. Those are also considered U.S. persons as well. Expats have to file tax returns as well if you're living overseas as a U.S. person. A lot of times what will happen is, especially as the foreign earned income exclusion has gone up in value, let's say someone who makes $120,000 or less may have they can exclude up to $120,000 of that income, earned income, along with certain housing expenses. So, you know, a couple married filing joint living overseas as U.S. person expats making $250,000 a year may feasibly have no tax implication, but that doesn't mean they don't have to file. You still have to file the tax return. It's just you also file a Form 2555 to claim the exclusion. For some taxpayers who are non-U.S. citizens living overseas in a treaty country, they may be able to make a treaty election to be treated as a foreign person for tax purposes. So if they have no U.S. sourced income, they may not have any U.S. tax liability, but they still have to file, because if you don't file, the IRS doesn't know that you're making this treaty election, and so you file the 1040 along with the 8833. The reason why all this is very important, especially for taxpayers abroad, is that there's something called passport revocation and denial. And despite all the fear-mongering and nonsense that you'll find, that is something the IRS has been enforcing significantly lately. So if you live overseas in a situation where someone might qualify for, let's take that couple, right? Let's say they make $250,000 a year. They each make $120,000. So feasibly, they have no U.S. tax liability. But because they didn't file their tax return and claim the foreign earned income exclusion, the IRS may think they owe $100,000 in tax or whatnot. So if you have more than, I think it's $53,000 and adjusts for inflation, then in seriously delinquent tax debt, then the IRS can come after you, and they can initiate a passport revocation or denial, which is very serious for someone living overseas that needs, if that's the only passport they have, for example. So what kind of income is taxable, right? The United States is one of the only countries in the world that uses a citizenship-based taxation model, not a residency-based taxation model, which means if you fall into any of the categories indicated above, you have to report your worldwide income on your U.S. tax return. You live overseas, all of your income is foreign sourced, you still have to include all of that income on your U.S. tax return. In addition, there's various international information reporting requirements as well. So for taxpayers who have foreign accounts, assets, investments, pension plans, life insurance policies, royalties, rental income, etc., that's all reported on a U.S. tax return as well. When it comes to income, it's also important to note that it's not just earned income. Passive income such as dividends, interest, capital gain is taxable, even if it's tax exempt overseas. In a lot of foreign countries, especially Asian countries, items such as dividends and capital gain may not be taxable the same way it's taxable here. If you're a U.S. person and you earn that money overseas, you still have to report it on your U.S. tax return. If taxes were paid overseas, you can claim a foreign tax credit. So similar to the foreign earned income exclusion explanation above, or prior, Sorry. Um, if you have foreign taxes that you paid, you may have no US tax liability, but the IRS doesn't know. You're overseas, you earn $400,000 a year, you paid 40% tax. Uh, so you think, oh, well, I did a draft on TurboTax and it looks like I don't know anything, so I don't have to file. Doesn't work that way, right? You still have to file your US tax return and claim the foreign tax credits. If you don't claim the foreign tax credits, the IRS doesn't know, and this could lead to liens, levies, seizures, written ex-at, and a passport revocation. So what happens if you do not file taxes or the FBAR? Should you file late? What to do? First thing is take a step back and don't just file forms haphazardly. You have to kind of look at the totality of the circumstance. Okay. If you have nothing but the income, then you could typically file it with reasonable cause, assuming that you're not willful. So if you're willful, you don't qualify for any of the non-willful programs or reasonable cause. But if you can show that you're non-willful, you qualify for reasonable cause, you file it late with a statement explaining why you didn't file it, things of that nature, right? There's amnesty programs we'll get to in a moment. There's reasonable cause, and then there's something called quiet disclosure. Quiet disclosure is something that you should stay away from. Sure, there are plenty of people who probably do it and they're fine, but if you get caught in the quiet disclosure matrix, you could be facing down the barrel of serious fines and penalties. And what that means is, let's say you're looking at your history and you go, well, I've been living overseas, I'm in Australia or Canada, the UK, I filed my taxes or my taxes were paid and I didn't know I had to do anything in the US. And then you learn, oh, geez, you've got all these requirements you didn't do in prior years. So you go, okay, you know what, I'm just going to start filing now forward. That's a form of quiet disclosure because you're intentionally omitting the prior year returns without getting into compliance. Or if you just go back and mass file your prior returns without a reasonable cause statement or under one of the amnesty programs, that's also a problem because the IRS will take the position that you're trying to avoid the penalty, you're trying to sneak the returns in. So it's something to consider before filing, to look at the totality of the circumstance, see which program you may qualify for, and I recommend at least to stay away from a quiet disclosure. So if you're out of compliance for prior years and you've got unreported income and maybe some foreign assets or accounts, investments, things like that, there's various different programs, right? If you're willful, the only program you qualify for is the voluntary disclosure program. There's like some new voluntary disclosure program for ERC, but this is like the offshore voluntary disclosure program. They used to have OVDP, which was an offshoot of VDP just for foreign accounts and assets and investments, but they got rid of that program at the end of 2018. Now it all falls under the moniker VDP. Okay, if you're willful, you would do VDP. If you're non-willful, there are a lot of other options available. You may qualify for the streamlined foreign offshore procedures and not pay a penalty, streamlined domestic offshore procedures and you pay a 5% penalty. Both of those programs are for foreign accounts, assets, and investments. You can also have some unreported U.S. income as well. The difference between the programs is just whether the taxpayer is considered a U.S. resident or foreign resident. If there's no unreported income, you may also qualify for the delinquent FBAR submission procedures or the delinquent international information return submission procedures, DIIRSP, but they modified that latter program. With delinquent FBAR, there's no penalty. With delinquent procedures, DIIRSP, they modified the program, I believe it was November of 2020, so they no longer offer an automatic penalty waiver, which is why so many 3520, 3528 penalties were coming down the pipeline. Alternatively, if someone is non-willful, they may also qualify for reasonable cause. And what I mean by that is if you're willful, you can't do reasonable cause. But as long as you're not willful, you can try to make a reasonable cause submission in order to have penalties abated or avoided or removed or minimized, because technically the IRS is not supposed to be able to penalize someone if they qualify for reasonable cause. We have a ton of free information available on our main websites and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.